Okay, Jim says, sorry about that. Jim says, how does the stock repair position work? I've had a couple of stocks that have moved against me, and I'm considering just closing and taking the loss. Sometimes that's not a bad idea, Jim, but it depends on the loss itself in that situation. He says, I have many other stocks. Apple, I do have Tesla that's actually up in price right now. I don't need to repair those, but I have a few positions that's dropped. And one position, ironically, is one position that I'm in that's MMYT. It's had a recent strong run. It's had a lot of recent strong runs. It moves up to like 78, 80, and then pulled back to 72. Then it moved up to 81, 82, and pulled back to 76. And then it moved up to 84, 85, and then it pulled back to 78. And right now it's at 85.95. Let's take a look at the chart there. And you see here, that's kind of where the situation was. It went up to 90, pulled back big time here, and went up to about here. And he says, my cost basis on MMYT is $90.70 odd cents. So 90.70, let's call that on MYT. Now, right now it's at 85.95. Right, you're down a little bit more than 5% on the position. What can you do to repair the position? That's Jim's question. What can I do to repair MMYT? I'm worried that the stock's going to continue to fall in price based on recent history. We can obviously see why. This is a married put I'm in that's bulletproof. But hey, we hit these peaks up in this range, as Jim mentioned, and then boom, we came down here to almost 74, 73. Then we climbed back up, got up to about 82, 83, and then boom, right back down to that 74 range. Now we've climbed up again, and we're here, and we're concerned about the stock falling back in price. So, 2 comments on this, Jim, related to your question and not related to your question in a way. Number 1, let's just illustrate the stock repair, see how that would do. And as we always do when we talk about the stock repair, let's talk about how we might compare this against other ideas to manage the position. So MMYT, first thing, MMYT. And we're going to go ahead and take a look at the stock repair. The stock repair tool is very simple. It only asks you for 3 inputs. Let's just say we have 100 shares of MMYT, and that's on the cost per share, not my number of shares. Let's put in 100 shares of MMYT. And our cost per share, as Jim mentioned, was 90.70. All right. Now we know the current price. We're down to 85.95. And we're down about 6% or so, 5.5%, 6% on the position. And so what this tool did in that brief moment, when we hit the submit button after we entered our information, is it went out and looked at all the options across the entire option chain for MMYT. And it tried to build ratio spreads, selling 2 calls and buying 1 lower call against the position. And it was looking for an initial net credit, and it found several. So what is our situation right now? MMYT is at 85.95 after today's pullback. We just saw the chart a moment ago. Our cost basis is 90.70. Well, to get to break even, we need an increase of about, what is that, $4.80 roughly, $4.75 roughly to get back to break even. Let's keep that in mind, $4.75. Now we have a ratio repair. We have a stock repair for the August expiration. It's about 40 days out in time, where we can sell 90 strikes, buy 85 strikes, and get a net credit of $1.50. Well, that would lower my cost basis to what? $89.20, right? $1.50 against that 90.70 cost basis. But it's showing me a break even of only 87.10. How is that possible? Well, what this ratio repair does is essentially you're buying 1 call, selling another, essentially creating a bull call debit spread, and selling an additional call that's not naked. It's just a covered call. We're going to be selling 2 90s, buying 185, and getting $1.50 net credit, which again puts the cost basis down to only $89.20. But remember, we're getting paid to own an 85 strike call. So the stock's at 87.10. That 85 call at August is going to be worth $2.10. And we took $1.50 up front, and our 90 strikes would expire worthless. So we get 360 back from the value of the long call. I'm sorry, the value of the long call, 210 intrinsic, 150 from the initial net credit. That gives us 360 with stock at 87.10, which is a value of 90.70. We're back to break even with only needing the stock to move up to 87.10 rather than going back to 90.70. Now let's take a look here at more of the specifics. I'm going to show you the breakdown of the repair details, and then we're going to look at the profit and loss chart, which will probably be more clear, but I want to see the repair details. In this scenario, owning 100 shares of MMYT, $90.70 per share. Okay, we're down about that, as I mentioned, that $4.70 or so. 475 loss on the stock, excuse me. We could buy an 85 August call for $6.90. At the same time, we're going to sell 2 August 90 calls for $4.20. So we generate $8.40 in premium. We pay out $6.90, so we get the $150 back immediately against our 100 shares, which lowers our cost basis down to the $89.20. But here below, we see what happens to the monetary value, as I mentioned, of the position. If the stock ends at 85, we have a $5.70 loss on the stock. We collected the $1.50 here, but we're still only a loss of $4.20. Well, that's something, but if we had just sold the August 90 call or even the August 85 call at $6.90, well, then we probably would be at a good break-even price anyway if we got a sign if the stock was above 85, you know, a positive return, Jim, instead of a loss in the position. That's the power of options. But at 87.10, what happens? We keep the 150, as we do in all scenarios, but you see at $86, that 85 call that we were paid to own, we took in the net credit of 150. So that 85 call we were paid to own is worth $1. At 87, it's worth $2. At 87.10, it's worth $2.10 plus the 150. That's the 360. That's where we're at break even on this scenario. Now, of course, the gain is capped. So as it goes higher, we don't really make much more profit on the position. At 88, we do. At 89, we do. But at 90, that's where the cap is. Why is there a cap at 90? It's because now the 85 call is worth $5, but the 90 calls have hit max value. We're going to get assigned on the bull call debit spread, but get 5 points back. But we're also what? In a covered call. Even though you're doing a ratio call spread, nothing is naked. One of these two calls is covered by the long call we just bought. That's your debit spread at 85.90, bull call debit spread. And the other sold call is the covered call against the 100 shares that you own. Let's take a look at analyzed trade. That's going to take us to the profit and loss chart for the position. Our cost of 90.70. Buying 1 August 85 call at 6.90. Selling 2 August 90 calls at 4.20, which gives us $840. So we've got the $1.50 net credit against our cost basis. That's the lower total cost on 89.20. And here is what the ratio spread would look like if we did that scenario. Break even back to 87.10 because of the value of the long option that we were paid to own. Capped gain of 6.5%. Let me jot that down. If the stock is trading above 90. Why? Because remember what we did. We just entered a ratio call spread, but essentially that means we did a bull call debit at 90 and 85. Sorry about that. And we did a covered call, that extra 90 call against our shares. So if the stock's above 90, the bull call debit spread would get the max 5 points back, and would be assigned if we didn't manage it, which you could easily do. You could just simply roll one call if it starts to move back above 90, Jim, and continue that as a covered call trade. But now at 90, excuse me, you'd be a profit at 6.5%. What was our original cost basis? 90.70. So where I'd usually be at a loss of just 70 cents and probably would try to continue to manage this as a covered call trade, sell some premium, knock that cost basis down. In this case, we'd be at a 6.5% return, where right now we're at that $475 loss, about 5% or so on the position, a little bit more than 5%, I said 6% or so on the position. Okay, so that's the stock repair in action. That's what we're looking at here in this situation. That's how the stock repair tool, Jim, works. And of course, there were other ones that we saw that were further out in time. We saw some November ones that we didn't go in depth in them, November ones, December ones. Why would I choose something that's far out in time? Well, only if the loss was so big that those are the only repairs that I've seen. Otherwise, I might consider simply doing a month by month covered call, generating premium to help me get back to break even on the position rather than holding it. Because as you can see, the repair works. But the max return on the repair, the max benefit of the repair is at expiration. If the only repairs I had were out to December, November, January, well, then I'd have to step back and say, okay, well, I can get this repair. I can get back to break even at 86 or 87, waiting 3, 4, 5 months. But how much could I do just selling once a month, or if it offers weekly, MMYT does not. But if I just sold once a month at or slightly out of the money calls, if I just generated 420 now with the 90 call, would that get me back to break even? Absolutely. Let's take a look at what that would do. It's not going to be quite break even. Oh, sorry, that's July. I want August. My apologies. We're going to sell the August 90 call. It's going to give us midpoint at 445. But see, even here, if the stock recovered back to 90, we'd have a 4.3% return, and our break even is at 86.25. So this is kind of the comparison you want to go through. The stock repair is a very, very powerful tool to help in most situations. If your stock's dropped 20, 30, 40%, and the stock repair is not going to work. I'm sorry. It's not going to help you get back to break even. That's just because of the issue. But this is the decision you have to make. Hey, the stock fell recently, 283. It's pulled back from my $90.70 price. I'm down that 475 roughly. How can I start making some of that premium? Well, you've made up most of it right now and could get a positive return if the stock is trading up at the 90 strike price, 4.3%, if you get assigned. Or you can continue to roll it and manage it as a covered call. Or you could do the stock repair, which would give you that 6.3% return, 6.5% return if the stock was trading above 90. In all scenarios, I just want to point out one thing. What are we missing? The stock repair is a great way to get back to break even. If a sudden event happened, you're down 5, 6, 7, 8%, and a repair is available. It helps you get back to break even faster without needing the stock to move up further to your initial cost price of 90.70. We saw an example of where selling the call might almost get us back to break even, almost covered that 475 loss with that August 90 strike call, 445 at midpoint. Well, we get a better fix here if we did the midpoint too at 445. Let's just go and see what that looks like. Of course, the price of the buy would be lower at midpoint too, but now we're talking about a 7.1% instead of what we saw at 4.3% with the covered call, because we're getting advantage of that bull call debit spread. But I just want to be clear on something. This, selling a call against a losing stock to convert to a covered call, works only if you think the stock has bottomed and is going to recover in price. What is the one thing that has not been addressed with the stock repair, with just selling a covered call, or maybe even getting a little crazy and selling a covered call, then selling an out of the money naked put, maybe at the 80 strike or something along that lines, which would put you in what's called a covered combination position. Looks something like that. This bend might be a little bit bigger after you get assigned, but you've got the naked put here, and then you've got the covered call. Neither of these three address the downside. If the stock continues to fall in our stock repair, now the net credit has increased a little bit to $2 instead of the $1.50. But if the stock continues to fall with the stock repair we initially saw, we've only hedged further loss by $1.50 of that credit from the ratio spread. If you just sold the 90 call, you've only hedged further losses by $4.20, that premium, or $4.45, excuse me, that we would have received for selling the covered call. Even in the covered combination, the loss is only equal to $4.45 plus any extra premium received for selling that out of the money cash secured put, which would be which would result in another $8,000 being held on account if we sold the 80 strike put. So essentially you are averaging down, you're putting more money into the position. The benefit of the ratio stock repair tool from PowerOptions is you're getting a credit up front. You're getting paid to get a better break even on the position than needing your stock to go back to break even without putting more money into the trade in case there is a further decline. But the hedge is limited to the credit you receive, just like in a covered call. The hedge is limited to the premium you receive on selling that initial position. All right, so I just wanted to make that clear, Jim, related to that, but those are some of the ideas that we have on repairing the position. I'm going to close this version out real quick. I'm going to navigate over to YouTube real quick. I'm going to go to our YouTube channel. Just bear with me 1 second. You're not seeing this right now. I have it paused. Oh, my apologies. Give me 1 second, folks. I just want to navigate over to here. There we go. Go to my channel. There we go. Okay. So anyway, what we're looking at here is our YouTube channel, some of the playlists that are available, and what we might want to look for here, searching across our channel, using that little magnifying glass link there to open up the search across the PowerOptions channel. We just want to go to stock. Actually, I think I'm just going to type in hedge. Let's just type in hedge. So that, let's see here. Now, ways to hedge a stock position is what I'm looking for. So if you're more concerned about protection, you still want to stay in MMYT, but you think that there may be some downside to it. You want to take a look at some of these ways to hedge a stock position. You could still maybe use the stock repair and hedge it directly. Bear put debits as a market hedge or as a stock position. Should I hedge my portfolio or stocks directly? Jim, those might be some positions you want to take. I'm sorry, some videos you might want to take a look at in that case, just to get some better ideas. The stock repair can work, but if you're concerned about a further downside, you might want to consider some extra protection, some extra insurance on the positions to hedge against further loss on the trade. Or the other obvious option, this is, someone mentioned this, JS, it says mention this, says just maybe close out the position, take the 5, 6, 7% loss and make it up later. And that's what Bill O'Neill, I think from William O'Neill, I should say, from IBD would say. You know, he talks about stock trading, stock positions, and if the stock falls 7%, you might just want to close out the position. You're close to that. You're right on that wheelhouse. You're knocking on that door of 7%. But that's another consideration. But if you're prominent and positive on the stock you're in, you think you've hit a bottom, that you think this decline was an aberration, you think it's going to recover at some point, then take a look at the stock repair. Compare that against just selling a covered call and maybe planning on selling a covered call 2-3 months out in time versus the stock repair, and see what's available for you, see what best suits your needs, your risk tolerance. But again, you can do all of that on PowerOptions. Just put in your symbol, click on stock repair, enter in your stock, it's already entered, but enter in your costs and your shares, see what's available for the stock repair for your specific position. You can evaluate the manual repair details, as we saw, of what would happen if the stock did X or Y during this time frame. And then, of course, you can analyze the trade directly, as we saw, look at the profit and loss chart, even run what if scenarios, and then compare it against other positions. So that's all available for you, Jim. And that's what you've got there. And then you can check out those other YouTube videos for further insight on hedging positions, hedging a stock position, hedging a portfolio, using bear put debits, hedging stocks directly versus portfolio hedge, much, much more. A lot of details there. You could even look up insurance and see a lot more videos, Jim, there as well.